What's going on, guys? Brian's here. Today is Friday, July 15th, 2022, and the market is open as I'm recording this. However, we will be talking about a swing trade that I took on Microsoft on this day right here, July 1st. Swing trading remains to be my preferred method of trading. It's a little bit slower pace. It allows me to have time to analyze the chart a little bit better, to look for other additional confluences as opposed to just price action. And it's actually easier for me to manage my risk. So in this trade, I actually did swing naked calls on Microsoft because I did think it was going to go up. So I'll go over a little bit of my checklist for the things that I was looking for. As in the quant trading app Discord, I posted it right here. This is on the first, taking a small shot at Microsoft naked 270 calls for July 8th and the at the money call for July 15th, the 260 call and a 270 call. And then this trader right here asked me what was I thinking for Microsoft. So I just briefly listed this out. If you've been following any of my previous videos, you know I kind of look for the same confluences with certain things. A 50% retracement. Is there a break of trend? Is there a little bit of divergence with certain things? So this is my checklist at the moment. So we will jump right into that right here. If we jump to the chart, let's go to the smaller time frame. So this would be our volume profile. The first thing that really caught my eye was this right here. This was a point of control from the previous week, and I liked that it was holding during this current week right here. Again, I took the trade on a Friday, so let's just mark this off on the chart, and let's make this a little bit bolder and put this color right here so we know it's a point of control from the previous week. Now we see this point of control here. Let's just round this up to 255 because I'm going to talk about 255 in a second as we look a little bit deeper. Normally I would just keep that as, you know, the POC, but for now, sorry for the confusion, let's just make that white. So we just have this 255 level. It's a line in the sand, but let's be aware that the point of control is right here. So let's jump over to look at the candlesticks. Now pay attention to earlier in the week as it sold off. It sold off a little bit below 255, but it was instantly bought up. The next day we can see that there was a lot of buyers that kept driving price up a little bit higher, or aggressive buyers as we can see. So on that Friday, aware of the pattern that was forming here. So we had a little bit of a technical pattern that was forming, but most of my trading these days is not based on technical patterns. However, you can't unsee them once you've spent years looking at charts and just drawing out technical patterns. I don't spend that much time drawing them on the charts anymore because you can just see it. I don't need to draw this trend line out here to see that this is a trend line. So as we take a look at the post again in Discord right here, we can see one of the reasons was the break of trend on the downtrend for this week. So now as we look at the chart, we can see that there was this downtrend that was forming right here and it broke the downtrend. We can actually jump to the 15-minute time frame, and then let's turn on the after hours just so we can see something else I would usually check. I like to check for trend lines on both time frames, as well as the extended hours turned on and off. Generally during the day I have the extended hours turned off, but I will just switch them on as easy as that was, just to get a glance to see how has the trend looked. So I was aware of this break of trend, and that's what caught my attention first and foremost. On top of that, the fact that 255 level was holding, then I started digging a little bit deeper to see how high it can go for a second for profit targets. But before we jump into profit targets, step one was the fact that there was a clear level to risk off of, which was 255. So buying close to 255, there was a little bit of security or feeling that there was an army of buyers at my back, if you will. So buying at 257, risking off of 255 felt sensible to me at the time, as well as looking for a potential profit target of 260, as well as all the way up to 270 was the final profit target on the trade, which is why I believe I said I entered in the 270 calls as well as the 260 calls. So the positive GEX, so we'll get into GEX for a second, but we can see the positive GEX, and the positive GEX was just saying it wasn't going to be as volatile in the short term, and 270, there was a lot of gamma exposure at 270. So that was one reason. That was another reason where I was getting my profit target from, as well as being aware of 260 as a possible resistance, but also the first profit target and 270 being the final profit target. Now to spoil it, I didn't hold all the way to my final profit target just because I'm not the best at holding naked options. It's very difficult, especially in this market condition. And if you've seen any of my previous videos, you guys know I actually enjoy trading spreads. So it's very rare that I will be swinging naked options, especially in a short time frame such as this one. I was swinging the options that expired today, and then the options that expired last week Friday. So I didn't have much time on the trade, and that inherently will always make me feel uncomfortable. Now let's jump back to the larger time frame and take a look at something right here, the 50% retracement in which I'm referring to. So as we zoom out, most of the time I like to wait for retracements before I enter a trade. I'm not the greatest momentum based trader, as if the stock is already running and flying, I will never trade it as well as if I get it after it's made a pullback. So if we take a look right here, this would be our retracement. So from here to here, this is what's referred to as a a 50% retracement, because this would be the most recent swing low. Price rallied, put in a top, and then it came all the way back down, and this right here is our 50% retracement. So usually between this 50% and 61% retracement, this essentially is a good area to generally look for long entries if a stock has actual momentum, because if it did not have momentum, it would actually just retrace all the way back down here, and that would be not a good, and that would not necessarily be a good sign. That's referred to as a double bottom. But for a stock that you're expecting there to be continued momentum, you'd want to see it stop at about the 50 to 61% retracement level. So being aware of that, let's just draw out a zone in this general area right here. That would be our retracement area, and then we can turn off this Fibonacci right there. If you're wondering why I chose this one and not this one, you can actually use both, but I'll tell you why in a second. Let's just take a look at the difference. If we were to use that as the swing low, this is the swing high, we can still see you get a similar zone. The reason I went with this one is because this is what's referred to as the swing low. This, depending obviously on your time frame, if you looked at the weekly time frame, maybe this is the swing low, but I'm on the daily, and this low right here, this candle actually took out the previous day's low, so this would be the new swing low. This right here was the previous swing low, but let's just say the Microsoft came all the way back down to maybe this price, and it came down to about here. Whatever candle this formed right here, this would be the new swing low because it took out the previous low. Hopefully that makes a little bit of sense. I'm long overdue on doing a video just on Fibonacci. I've been talking about that for, I don't know, maybe a couple years now, and I did a couple private webinars a couple of years back, but I've yet to do one dedicated to just how I use the Fibonacci on YouTube. It's just a good tool to use. There's nothing more complicated. I don't get super fancy with it. I just look for 50% retracements and 61. Anything else to me is just noise. You just want to see a stock go up, come back. It makes complete logical sense. It's half off from the price that it was. As humans, we like to feel as if we've gotten some sort of a deal. So if we know something was going for, let's just say $10, and then we saw it go all the way up to 20, if it comes back to 15, we know it's half off from the price that it was before. So that's just psychologically a good place to look for some sort of an entry. On top of that, the daily candlestick right here from the previous day was a very indecisive candlestick. We can see both bulls and bears are fighting to gain control. So it's a very indecisive candle. That's generally something you'll want to see after a stock has made a pullback, because it could be an indication that the selling pressure has stopped as bulls are starting to come in and neither side is winning. So the following day is usually a good day to watch the stock to see who ends up winning. Jumping back into the smaller time frame, one thing to also take note of, as a swing trader, I'm going to be a little bit more aggressive towards the end of the day or during the morning. I'm usually managing positions or entering positions towards the end of the day. During the middle of the day, you're kind of doing other things, or you're analyzing, or you're waiting to see how a stock will react going into power hour. So if you see some sort of momentum building coming out of lunchtime right here, so this is 1 p.m. Eastern time, if you see some sort of momentum building, or if you see volume increasing going into the close and a stock is rising after it's broken a downtrend, that's usually a good sign of follow through momentum. Now we can see what happened after it was a long weekend, so the market was closed that Monday, but you guys can see on Tuesday it actually gapped down. So this is always a little bit of a nervous thing to see when you're swinging. The first day you would prefer if it gapped up, because then if it came back, at least you know you won't really be in the red unless you're in very short-term options. But this gap down right here was a little bit more annoying than anything. I wasn't really too concerned about the position. However, you can see that the 255 level held. So whenever I'm choosing my strike prices or I'm choosing my position size, if I know this is the level I'm risking off of, obviously I'm going to analyze the trade on using something like a tool like Option Strat. I would say if I was to buy a call, and let's just say we're mocking up the same trade and I'm going with the July 29th call for Microsoft and I want to get 270, but then I want to know if over the weekend, if Microsoft was to actually sell off, to get an estimate for how much would I be down on the contract. If Microsoft doesn't move at all, I'll be down about 50 cents in the contract. That's just because of time decay. And if Microsoft was to actually drop 2 points, I'll be down about a dollar on the contract, so down about $100. So you can use a tool to already assess how much you'll be down, even if you're just trading a naked option. I'm pretty sure if you've watched any of my previous videos, I've talked a lot about Option Strat and how I use it for analyzing my spreads. But it's the same thing which I do here. If I know I'm going to be a buyer here and I know this is where I'm going to want to stop out the trade, the first question I'm going to ask myself is how much will I be down if the stock goes to that level, and then that will determine how many contracts it can get. So if my general stop loss is going to be around $500 is what I'm willing to give a trade that I can find multiple confluences like this, $500 seems to be fair, because if I keep it simple and I say, you know, $100 in risk for every reason I find to take the trade. So if I find 5 reasons to take the trade, there I go. I can get $500 5 contracts, which means how much will I be down if Microsoft was to come down to here? If the position size is going to be down, $750, then it means maybe I should only get 4 contracts as opposed to 5, because my stop loss is going to be $500. So that's one way to, assess your risk or analyze your risk before you get into a swing trade, because again, you have plenty of time to get into it. And I'll generally get in a couple once I have the idea, and then decide how much size I want to get to go as the momentum is going. As we take a look at a couple other reasons, so this right here just says bullish divergence in the algo flow. So this right here is just using the TradingTix algo. So it's part of the quant trading app Discord right here. We can just request this. So I was just checking the algo flow, and it was showing a little bit of bullish divergence. So this is what the TradingTix algo is just saying, that price for Microsoft belonged up here, and this is where the current stock price was. It was all the way down at 258 at the time in which I did this request. So this right here is enough bullish divergence for me to get pretty excited, because it's just adding confluence to what I already saw on the chart. Again, my reason for taking the trade is not just because I saw this divergence here. It's because I already had the trade ideas. There was already multiple other confluences, and I'm just looking for extra reasons to confirm what I already see on the chart. On top of that, I believe I said something about there was a little bit divergence also with the NASDAQ. So let me see. I don't remember when I would have requested it, but I was aware that there was also divergence in the Qs for that week, and don't know exactly where it was requested in here. But let's just jump back to the chat right here. Same thing as the Qs, and then I like that to reclaim the QTA buy zone. We'll disregard that for now. QTA is just the quant trading app buy zone, and we had to break it down trend. So positive GEX right now, as I briefly mentioned. On top of that, there was a decent amount of open interest to the upside, and I really like that. On top of that, there was a lot of volume that was coming into the upside. So if we jump over and take a look right now, this is the upcoming week. So this is 7 days till expiration. This is the gamma exposure page on quant trading app. So as we scroll down right here, these are potential levels for next week, say for example. And if we want to see how strong those levels are, let's just turn on this absolute GEX right here. We can see that this is not what I was looking at the time, because this is now for the July 22nd expiration. But we can see there's a lot of gamma exposure at this level. This is where Microsoft is currently trading. If I'm interested to see how much volume is actually going into which side, we can see that there's still a decent amount of call volume going into Microsoft. So using information like that to get a sentiment for what's happening in the options chain is always going to provide some sort of edge. We can also see why it struggled to go below 255, because that was a very strong level from the options chain. There was a lot of open interest and puts at that level. Generally, whenever that happens, you'll see something that's referred to as a put call wall. So it's pretty much a very supercharged support resistance level. You can think of it that way. It also was the absolute GEX level at one point during that week. So all these things, if it sounds like I'm speaking another language to you, don't worry about it. It's just saying there's a lot of confluence at 255, and we can see that on the chart, because again, 255 was also right next to a point of control. So we have a volume profile adding confluence to our trade idea. This right here is the point of control. This is also a demand zone. So all these things in this area are pretty much pointing, saying this is a good place to look to get long Microsoft. On top of that, this gray shaded box is from our 50% retracement from the daily time frame. So we can see right here in this zone, that's our Fibonacci retracement. So all this confluence, all these things aligning to this area is just screaming as a swing trader, I almost have to take this trade because the risk is going to be worth it. And since I'm also predominantly swing trading, I'm generally hunting or scanning or looking around. And by scanning, I don't mean I'm using some sort of scanner. I only look at the same stocks all the time. By scanning, I mean I'm checking different data points. I'm checking to see other types of confluences right here. If I want to analyze Microsoft right now, how is its gamma exposure looking? Which volume is going into which side? How is the open interest? Different data points. The better the data points, the better, but as long as it's not crippling. And of course, again, because I'm swing trading, I can take 30, 45 minutes to analyze all this during this time, because I was already checking from around here. And then the moment it broke out, I was like, okay, let's just get a starter piece right here. Now, in terms of profit target, I use in this case the gamma exposure as well as where the high open interest levels were, which was 270 and 260 as potential profit targets. I always like to try and get some sort of an at the money call that has a little bit more time on it. And then these are essentially the lottos or the YOLOs, if you call it, in case it actually goes to the moon and you actually get some sort of 500, 600, 700% return. But there's never really a lot of risk that I put on these types of trades. If we were to take a look now at the options themselves, this right here was the day in which was entered. This right here is the 260 call. So the 260 call going for $5.40, which was my average. I believe a little bit later here, I just posted. So this would have been, it was already up 15% the moment in which I had got the 270s, and then the 260s at this point were already up, because I don't remember how long I had already been in the trade. But as you guys saw in the chart, Microsoft already started rallying on the Friday. So it was already starting to work itself out pretty well. But 550 was my average here, and then 46 cents was my average on the 270s. So as we take a look at this right here, the 540 as an average was looking pretty good. Tuesday morning opens up and it's down about $1.60 on a contract. Now generally I'm not comfortable holding contracts like this below $1, but because there was so much confluence at that 255 level, that's what's important. And if anything, that's the key takeaway from this video. The more confluence you have, the more confidence you have, or the more reasons you have for taking the trade, the harder it's going to be for you to get shaken out of the trade. If you've done your due diligence and you've done your work and your research, even if you're a short-term trader and you've found 5 data points that all confirm your thesis, doesn't mean you're going to be right, because not everything's 100% in the stock market. As long as you're managing your risk, you'll be okay. But it's not, this gap down wasn't going to shake me out. I didn't actually even really look much at it. I think the other trader that I took it with me that I was aware of in the Discord, I think there was either 2 or 3 others that took it with me, but the one that was vocal about being in the trade also, we were talking about potentially adding down here because it finally came to the level in which we wanted, which was 255. So now we can actually get more contracts right here for a better average, pulling it down to bring it to around something right here. Now, when it did hit the 260 level, which was right here, I'm just showing where I actually took profit at this point. So the one thing I did wrong actually was I actually went completely flat, which is not something I generally do, but that's just because I was trading these naked options, and it's always difficult, especially for traders such as myself, where maybe 9 out of 10 of my trades come from spreads. Whenever I trade naked options, I don't hold them as long as the spreads just because of the time decay, and you get to the point where you just know a little too much to hold naked options, and it just becomes a little bit more difficult. Versus a couple years back, I would have no problem holding these calls, thinking they'd go all the way up here. And obviously, market context, the market is in a bear market, so obviously if you're holding long trades, if you're holding trades to the upside, you don't want to be holding them for too long. So I took profit here, but you guys can see how high this thing actually ended up going. So about a 30% return on that trade there. The 270 call was completely crushed, which is why you don't put too much money in the short-term out the money options. It was down about 88%, but because I didn't have much size in it, I was totally fine holding it and then also taking profit right here. So about a 30% return. Again, these are baby gains, but you guys can see how high it ended up going because it actually did end up making it almost all the way up to 270. Again, I was flat right here. Didn't look to get back, and that was the only thing I think I mentioned within the Discord, just saying the biggest mistake was just going flat. On top of that, I also did not run a spread. Usually I'll do a hybrid. I'll run naked options as well as run a spread. So if we just take a look at, this is what's referred to as a call diagonal. This is just showing, if we take a look at the risk profile actually on option strat to show you guys, let's just say for an example, I did something like a diagonal call spread, which would be buy whatever call, the price that you think it's very likely to actually make some sort of money, and then you can sell another call that's out the money for a shorter term time frame, because this call is going to be losing in value faster than this one would be because of time decay, and it just helps, it helps smoothen out your P&L curve. So just to show you guys this, I've done videos on that, but I don't want to spend too much time talking about the spreads in this one. We can see this price would have been going for about 520. The big drop down was about $1, so 420 before hitting the profit target right here of about 650. This would have been a contract you can hold a little bit longer, because you can see not only would it have a little bit more time on it and theta being on your side in this particular case, it's also because the drawdown was not as bad, and you're not going to lose it all like a naked option within the same couple of days or within the same week. Now, I really enjoy swing trading just because of how much easier it is to manage risks. It's just so much slower pace. My objective is to try to get at least 10 solid swing trades in a month. And with 10 solid swing trades in a month, if you're position sizing pretty well, there's 20 trading days. It takes a lot of pressure off, and I'm not necessarily talking about non-directional income generating trades like iron condors and iron butterflies. I'm talking about just 10 directional trades a month. And if we take a look at a calculator like this right here, just showing an example. So if you take 10 trades and your win rate is about 60%, and you can average about 50% $500 returns, and your drawdown is about $300, which is pretty good for if you're trading naked options. This is actually difficult to achieve. Expected monthly income could be about $1,800, and this is just with 10 trades a month, guys, right here. But again, this, you have to be really, really good to get this, and I consider myself a good swing trader, but achieving this consistently is difficult with naked options. My preferred method is using spreads. So with spreads, you can really cut down on your drawdown or your max loss and keep it to about a 2-to-1 risk reward ratio, because it's very difficult to get a consistent 3-to-1 or 2-to-1 when you're trading naked options and you're swing trading them. But if we look at this right here, if we're taking the same 10 trades and aiming for the same 500% returns, but this time keeping it to a managed risk of 2-to-1, you'll actually generally end up getting a little bit of a higher win rate, but I'm keeping the win rate the same. You can see the difference between the returns right here, an extra $200 a month. But if you can just get your win rate up to maybe something like a 70%, which again is not too hard with spreads because you can manage them a little bit better, you can see how it increases your P&L at the end of the month exponentially. And $500 returns, you know, is realistic if you have an account size of about 10K and you're patient enough and you know what to look for, and you tell yourself, again, you only need 10 solid trades, because the market is providing really good swing trade opportunities. As you guys can see, this was a really good one. We actually had a really good one yesterday that I actually fumbled the ball on. I'm actually planning to do another video on that one. Probably will record it right after this one, just because, again, those contracts expire today and I want to make sure to get this content out to you guys as soon as possible. But I did open up a swing trade on Microsoft here, but then I closed it out here. I didn't have the same conviction to hold for my profit target of 255, just because this time I went with the weekly contracts, and that's always a reoccurring theme. When you trade weekly contracts, it's harder to hold because you tell yourself if you're wrong, you're pretty much going to lose it all right away. But this trade was a monster trade right here if I did hold the position, but it is what it is. Hopefully this video shed some light a little bit on some of the things that I use to look for good swing trades, as well as different ways to look at a chart, keeping it pretty simple. As you can see, there's nothing necessarily fancy on my charts here, guys. It's just basic price action, a little bit of the volume profile, and then a couple extra tools such as, you know, gamma exposure, or using QTA, which is quant trading app, for a little bit extra confluence, and using the gamma exposure and other little tools out there. But at the end of the day, it just starts with a good idea and then a good risk reward system in place. Thanks for watching, guys, and I'll catch you in the next one.